Hi, great to have you here again. Let's talk about different trading styles. You might know that different traders have different trading styles. Some of them are highly active, while others prefer to take their time in thinking how to execute their trades. Traders simply have different personalities and therefore they have different preferences and goals, and all this results in different styles in trading. Most traders employ one of the following trading styles: scalping, day trading, swing trading, or trend following. I'm going to quickly take a look at these 4 styles and give you some ideas how these trading styles work so that you can choose the one that fits your personality. First of all, please do remember that we don't provide any investment advice and all the material is made available for educational and marketing purposes only. And please remember to subscribe to the channel. That would be a great help. Thank you. Scalpers often use very low time frame charts. We talk about 1 minute, 2 minute, 3 minute charts. And while I'm not saying that this strategy I'm going to share with you, or these entry techniques I'm going to share with you, I'm not going to say that they are the best, but I'm using them to demonstrate how the scalpers operate. So first of all, like with any kinds of trading, you look for momentum. So for instance, here we can see that the market was moving down a little while, which eventually caused the faster moving average to cross below the slower moving average. The price never follows the indicators, it's the other way around. So the indicators work as a highlight on what's happening with the price. So let's say that you had an entry rule where you wanted to see a downtrend. And the first condition for a downtrend is that you have the yellow, the 20 period moving average below the 50 period, and then the market is somewhat overbought, meaning that the stochastics oscillator is close to the 80 level here. So then what you might want to do is, once the price hits the 50 period moving average, you might want to consider selling the market. And then you obviously have to answer the question, where do I place my stop? And that's something that I leave for you to figure out. But you also have to figure out where you place your targets. So for instance, because the market is trending lower, we might want to use the previous price action as a guide. So we have a swing from that high to this low, and if we make a projection from the latest high here, we see that the market eventually moves all the way down there. So that swing is roughly the same size as the previous one. So sometimes that works, sometimes it doesn't work. So a safer alternative is to go for a very small number of pips. And the way to do that, the way that scalpers do this, is that they want to look at the previous low. If they're looking to sell short, they're looking at the previous low and the distance to it. So let's measure this distance. Basically, if you grab this tool and drag from one point to another and hold the left mouse key down, you can see that this is 8.2 pips. Or 82 points in MetaTrader 5 language. So to be on the safe side, when you are shorting this market, let's say that you wait for a move lower from that 50 period moving average and you sell the first red candle here. Then your open profit potential, or the profit margin rather, for this trade would be, based on this, about 6 pips. So you place your target there and you make 6 pips when the market comes down here. So that was pretty much what many traders were thinking. They were pushing the market lower. There were no green bars there. But then once the market hit that low, people started taking profits. And then the market drifted further, sideways a bit, and then moved lower. But that's the way you can think about scalping trading. I'm not saying this is the only strategy and you should I strongly recommend that you go and study previous price action in different markets to figure out what's the style that fits your personality and your goals. But just to give you a demonstration, this is what the scalpers do. They look for these opportunities over and over again. We can see another opportunity here in this chart. The price rallied back to the 50 period moving average, and then the profit potential from this trade was 11.2 pips. If you sold near the low of the first red bar, then your profit potential was about 9 pips. So maybe you decided to go take profits between 5 and 10 pips if you were a scalping trader in this situation, and that's probably what most people did here. The market moved about 6.8 to 7.8 pips, and then the buying started. People they basically exited their short positions, and maybe some of them tried to go long, but then the market continued lower. Anyway, that's the way the scalpers look at the market. Hey, if you find this video helpful, please do us a favor, hit that like button and also subscribe to the channel. And if you want to help your friends to get to this great content, please share this in social media. Thank you. People who trade the markets intraday could be called either day traders or intraday traders. The language you use really doesn't matter. What matters is the way this functions. And I'm going to show you how you can use this style. There's obviously many more ways of doing this, but I'm going to show you something that, with my experience, I've been trading and analyzing markets over 20 years now. So this is something that is simple, easy to learn, and something that you can start employing pretty quickly once you've watched this video and gone through some historical price charts to make sure that this is something that works for you. But this is probably as simple as it gets. First of all, the main principles in any types of trading is that you need the market to trade with you. If you are long, you need the market to go higher. If you are short, you need the market to go lower. Otherwise, you can't make money. So it stands to reason then that when you see the market moving higher, you should be looking for opportunities to buy. And when you see the market moving lower, you should be looking for opportunities to sell. So how do you do that? Or how day traders do that, I think is rather the question. So let's go here and choose the horizontal line tool. And I'm going to set this to a level that has been clearly quite important in this market. So again, this is gold in 1 hour time frame. And you can see how the market touched this level here. It wasn't able to get through the level first, but then it found support at the same level again and again until the level was penetrated. And now suddenly the same level became a resistance level. And here we had the first opportunity to take a short, and then came another. And I actually alerted our traders in my daily analysis to these opportunities. So after watching this video, you know what to do when you see something like this happening. Here we have the market moving to this resistance level around the same time when the London trading opened on 18th November 2022. And what you can do, you can either sell at the level and see what happens, or what some people prefer to do, they wait for a reaction from the level, which is kind of a evidence that the market is actually is reacting to the level, and there's some selling coming into the market. So let's say that you choose the latter option and you sell short here, and then a little bit later on that day, I'm looking at this in the European time zone, so it basically covers the London session and the New York session partly. So here, about 10 hours later, the market has moved $17.75 per contract, which is about 1%. So significant move per contract, and all this just by taking one trade up here and then waiting to see if the market moves. And in this occasion it did move. So that can be very stress-free strategy if you just know what you're doing and let the market do the work for you. When we talk about swing trading, we refer to catching these price swings that we can see inside trends. When the market is moving higher, it has these directional moves higher and then retracements. Directional moves up and retracements, and that's how the markets move. And that the same happens when the market moves to the downside. You have a directional move and then retracement, directional move and retracement. And the art of trading is to find where to enter and exit these trades. What swing traders do, they like to catch these directional swings. So they want to go with the trend, not against it. So I'm going to give you very quickly a couple of examples that you can then study and see if these could work in your trading. So first of all, this is Euro Aussie in the daily time frame, meaning that each candle is 1 day of price action. And here we have the market moving above the moving average. Here earlier it was moving below, but now it's moving above it. And we get a retracement. When you have something like this happening, that's a possible trade opportunity. You don't know if it's going to work for you, but you have to monitor the market. Now we have a retracement, and one of the ways you could, there's lots of different ways, but this is just one of the ways that you might consider trading a market like this, and that's taking a long position when the market moves above the high of this daily candle. So you have some indication with this wick here that the market could be moving higher, and then you want further confirmation that this is actually going to happen. So you wait, you place a stop above, in this case above one spot 46.44, and then you just wait. Obviously you need to have your stops in place. This is an example where this works, and you probably don't get stopped out if your stop is far away, far enough, but you have to have stops so that you're not exposed to unlimited losses. The idea is to stay with the trend as long as there is upside momentum. Here on the third candle, on the third day, the momentum starts to die. There's a big rejection wick up there, so making this a rejection candle. And this is followed by a couple of days market moving lower. That's one way of looking at it. Then now we can see that the moving average, and this is 20 period moving average by the way. Now we can see that the moving average is pointing higher, so we might want to be buyers somewhere close to the moving average, because sometimes they work and act as support levels. So once we get a touch on the moving average like here, this could be an entry into this market. And then we stay with the market as long as we see momentum there. As long as we don't see the market turning red or moving below the daily low. So this is where it gets tricky. You see the market coming down quite a bit, so you might want to take profits there. But you can never be sure. That might have been the wrong time to exit. That's just the way it is. You just have to accept that you made money here. Traders sometimes they go to this negative mode where they always think about the negative and not the positives. The fact here was that the entry was good around the moving average, then the price moved nicely into the direction we wanted, then the exit was less optimal, but that's the way it often is. So it's something just that we have to just live with it. Okay, with trend following we talk about trade durations from anything from few weeks to few months. Here I have USD yen, which is a great example. And while I'm not going to suggest that this is a sort of exhaustive presentation on trend following approach. There's so much to talk about. I'm going to just give you some guidelines on how trend following traders usually approach the market. So here we have the market moving sideways, no real trend, but then comes a point where the market breaks to the upside and starts to move higher. So there could be an entry point to this market, maybe buy on a pullback, and then stay long as you see the trend developing. There's often the first stage is more radical than the rest of the trend. So that was the case here. The market rallied nicely and then it settled into this channel, but it was trending higher nevertheless. So depending on your trading style and depending on your definition of trend, you might have stayed with the market as it moved higher. And those that did, they really made nice money in this market because there were some central bank policy divergences behind this huge move. The Japanese central bank stayed extra dovish and still is, and the Fed turned quite hawkish. So the market really moved higher. So the idea is that you stay with the trend as long as the trend lasts. And once the market, after a big move, starts to move sideways, then you might consider exiting the trade. I hope this video helps you to choose the trading style that is the best fit for your personality and skill level. Now take a moment to subscribe to the channel and also go to tiomarkets.com/register to get your very own low-cost trading account and start building your trading business. I'll see you soon on the next video.